Hello, Anthony.
Hello, Claudine.
We're talking today about C-Corp audits.
And this is one big, huge area of tax controversy law.
Yes. And we're going to give some situations that would tend to invite scrutiny from the IRS. But, first, I wanted to look and see what are the chances of being audited. So I did I couldn't find a ton of stats, but the ones I found are this. So if you're a small C-Corp, total assets of less than $1 million, in 2010, there was a 1.4% audit rate. 2014, that dropped to 1%. Okay. $1 to $5 million in assets, your audit rate in 2010 was 1.7. 2014, it was 1.2. Now we start to get a little bit higher here.
Yep.
$5 to $10 million in assets. Audit rate in 2010 was 3%. 2014 was 1.9. And then we hit the big boys.
Yep.
$10 to $50 million in assets. Your audit rate in 2010 was 16.6%. In 2014, 6.2%. Now we know that the IRS is not manned as heavily as they were in 2010, but that $10 to $50 million looks like they're getting hit.
They're getting hit, and we know that the IRS is looking that they've gotten marching orders from Congress, enough with trying to make everybody comply and check on everyone. What we're looking for is the money. So they've been going to the targets where they're pretty sure they can generate money. C-Corps, there's a lot of things going on there. Lots of ways to assess additional taxes, and a better way to collect, and a more promising way to collect, and also corporations with foreign subsidiaries. Very, very hot topic going on now.
Yep.
And I would just say, we're going to go over some of the audits, and if you do have a C-Corp, you've probably been through an audit.
Yeah.
So you could probably, you know this stuff inside and out. You remember those issues coming up very well.
And just as a side note, I thought it was interesting. S corporations, LLCs, and entities taxed as partnerships, their audit rate in 2010 and 2014 was the same. It was only 0.4%.
Yeah.
Another reason, a little easier to fly under the radar there.
Yeah, another reason that if you are not offering stock options, if you are not looking to be acquired, you might want to ask, what's the real benefit of being a C-Corp? Maybe you want to convert to an S-Corp.
Yes, because you automatically sort of are a C-Corp unless you state otherwise.
That's right.
So people, I think, assume, I just have to be.
Right.
So, yeah, there are options.
Yeah, there is massive amounts of confusion with this.
Okay, so some situations that might draw attention to you from the IRS: excessive meals and entertainment.
Yeah, always.
Yeah.
But I would say this, you sort of, with a C-Corp, you're kind of allowed a little bit more spendiness than if you were if you were a sole proprietor or something. The C-Corp does add this layer, or it should, if things aren't done right and you're following your processes, you're kind of allowed a little bit more leeway because there's a whole corporate policy involving many people.
Okay. Let's talk about cars. So auto expenses too high, or the other big one, claiming 100% business use of a vehicle if there's not another vehicle for personal use. Yeah,
that one, it's such an obvious one to avoid. Mostly every business owner I know, they have a car that the business is paying for. And one of the easiest hedges against the risk of getting everything cut off is like, well, come on, if that's the only car you have, how can you possibly not have any personal miles on that? So, get yourself a beater. Put some miles on it. Do not do that. You're getting a little bit too pushy, and it's such an easy one for an auditor to blast you out of the water, and now your credibility is a little bit hurt. You're not. Now they can come like, okay, well, if you got this, and now we'll get you on this. And sometimes it's better when you're in an audit just to say, you put your hands up, oops, we made a mistake before they get to it. Hey, we made a mistake on this, but we're right on this, as opposed to just sort of hopefully, let's see, where are the cars you have? That's it.
You can't see me, can you?
Yeah.
Okay. Loans to officers instead of payroll.
Yeah, that's a nice way to, give a loan instead of payroll so you don't have to pay. So there doesn't have to be any, the corporation's paying taxes on the loan amount because it's the profit. Apparently they got the money from somewhere, unless the corporation got a loan that they're giving a loan. That's one way. But that's a way to get money to an officer without putting it on the payroll where you have your payroll taxes.
Yep.
And then the officer also has to pay income tax on that.
Unreasonably high salaries paid to shareholders who are also employees.
Yeah, so you know why they do this, right?
Less profits?
Yeah. Yeah, you need to beat down that profit. Those C-Corp tax rates are terrible. The highest rates in the civilized or uncivilized world. We have the worst C corporation tax rates, or corporate tax rates, I should just say, than anybody. I mean, they're insane how high they are when you combine that corporate tax rate with that dividend tax rate. It's insane. What 60% isn't enough for you? I mean, that's really what it is. And so this is sort of why C-Corp's audit is the most contested area of law, because the stakes are so high. If the IRS actually wanted, or if Congress ever did, I'm not going to say they were going to want this, but if they ever wanted to actually increase revenue, is just lower the tax rate so people aren't sort of having to create these seemingly desperate situations where, like, I can't afford to pay 60%. That doesn't leave, 40% doesn't leave me enough for growth. It doesn't leave me enough. I have to take these risky moves because you really aren't giving me a lot of choice.
Yep. So you don't want to pay your admin assistant $5 million a year.
Right. Well, maybe.
10?
Well, no, if your admin assistant,
Is
it might be,
good.
this is really for shareholders. If your admin assistant is a shareholder, right. If you're saying you take your shareholder, you'll be my admin assistant.
Yeah.
And this is a way to dump off that corporate the corporate income onto just someone's, so they're just paying personal tax. And when it's your family members, that's a big one. Like, okay, all my family is on there, which is a good thing. Just make sure they show up every now and then, kind of require them to do something. And if they're kids, you know what? Kids can handle a lot of responsibility.
Sure. No interest paid, no interest received on officer loans.
Yeah. And so that's just sort of like, because it looks like you're just moving money around to,
retained earnings from prior period, not properly rolled to current year.
Yeah.
Forms 1096 and 1099 were not issued timely.
Yep.
Just a little flag there for the IRS. Corporate balance sheet doesn't balance.
Yeah.
Another one. Profit margins are inconsistent with prior years. So if there's a huge jump.
Well, usually.
Either way.
And but when I read into that, I'm like, your profit margins have been negative for the past 10 years. Yeah. So how are you still here? That's sort of
Can we
how
get
I
your
read
business
that.
plan,
Right,
please?
Well,
corporation with retail business involving inventory, but you have zero ending inventory.
That's amazing. Talk about an efficient inventory control. That's amazing. It's possible. Yeah. It's possible. I would say, if you were in, if you did Christmas sales, December 31st, it's out. Also, another one, fireworks. Oh. Right?
Halloween,
right. Or you're selling perishable goods. Yep. Maybe. Yeah. Okay. So it's possible.
And lastly, expensing too much office or life insurance.
Yeah. I mean, one of the things, life insurance is just a great product we love all around, just because of its tax free. And so you could sort of, a corporation can buy tax policies on its corporate officers.
Okay.
But what it is also, if you're getting a whole life policy, it's also an investment vehicle. It's not just covering the death benefit like a term would. A term would be completely expensable. You're covering, the loss of them. But if you're getting a whole life, there's an investment vehicle in there as well. So you're basically, if you're trying to dump off, if you're trying to claim an investment is an expense, that sort of stuff doesn't fly. You're going to have an issue with it. And that's one of the big things. People try to get investments as expenses, and it really doesn't work.
Got it.
Yeah.
I think basically what we're saying here is if you're too aggressive in getting income off the books.
Right. Even though and the incentive is massive to get it off the books, but the IRS is aware of it. But there's some great strategies you could use, and you really want to think about the premium of being in a C Corp. Is it worth it? Is it really worth it? And if you've been doing it for a while and you're thinking you're going to be you're going to be bought out, you're going to offer some sort of stock options, and even with some S-Corps, you can do some sort of you can give stock ownership in an S-Corp, depending on what it is. You might just want to think about it because there's a lot more opportunity to lower your tax rate with an S-Corp as opposed to, and I think this is the thing, once you are a C-Corp, you are going in with the big boys. You are going in and the level of scrutiny is going up, and the imputed level of knowledge to you is also going up too. They're going to expect that you know more. And you probably do, especially if you've been through one before. You probably know a lot. Yeah.
All right. Well, what you can do is subscribe to our channel. We're going to be continuing our series on corporations. We'll talk about tax brackets, S-Corps, LLCs, all sorts of good stuff. So make sure you'll get updates. You can like and comment below. You can visit us at IRSMedic.com. And thanks for watching. IRSMedic, the law offices of Parent and Parent, LLP, real tax attorneys for tough tax problems.